Okay, so a third major reason for including property in your investment strategies is leverage. Now, the UK property market generally works on the basis that the purchaser puts down a deposit and the balance is put in by a mortgage lender. The mortgage lender is only interested in receiving the interest throughout the period of the loan and getting their initial capital back at the end. So although they secure their capital against the value of the asset, they do not make any claim against any increase in the value of that asset during the lifetime of the loan. So long as you maintain your payments, whatever increase in asset value throughout the loan term is entirely yours. So in other words, because you've leveraged the whole deal, which means you only put in 25% to actually take control of 100% of the whole asset, your money is actually working 4 times harder. Let's illustrate this using a simplified example and with rounded off numbers just to keep things easy. Bear in mind it's a concept I'm illustrating here. This is not a case study, so I haven't included transaction and legal costs. They're not taken into consideration. Just want to show the concept. So we've got Jack and we've got Joe. They've each got £25,000 to invest. Jack follows the stock market a lot and thinks he's identified an excellent 10-year bond expected to grow at 7.9% per year. Now that sounds a familiar figure, doesn't it? I've used the 7.9% because that's also what we'd expect the housing market to grow at, or housing capital values. So we want a direct comparison. Okay, so Jack purchases his bond. He pays £25,000 for it. It's worth £25,000. I say his investment is £25,000. And he sits back and he watches the bond grow. And yes, the bond does grow at the expected 7.9%. So again, going back to the approximations we used earlier, that's equivalent to the asset value doubling after 10 years. So for the purposes of this illustration, after 10 years, Joe's bond is now worth £50,000. Now when he comes to take it out, there's nothing to pay because it was all his money he put in. So the entire £50,000 is his. So his remaining equity in his asset is £50,000. The growth in that equity, so it's gone from 25 to 50. So he's actually earned £25,000 in the 10 years by investing 25,000. So if we come to a figure called return on capital employed, and again, don't worry too much about it, but it's a way of measuring how effectively your capital invested has worked. The equation is the amount of growth seen over the original investment. So we've got 25 over 25. We multiply it by 100 to get a percentage. So for Jack, his £25,000 investment in the stock market bond has given him, after 10 years, a return on capital employed of 100%. Not to be sniffed at. But now let's have a look at Joe. Joe's a Yorkshire lad. He's always heeded his granddad advice. There's nowt like bricks and mortar, lad. So with Joe's £25,000, he decides to buy an investment property. Now the property value is actually £100,000. There we go. Asset value at start, £100,000. Jack puts down a deposit of £25,000. The remaining £75,000 is put in by the mortgage company. Once again, the asset grows as expected at 7.9%. But because the asset value at start was £100,000, doubling after 10 years makes it £200,000 at the end of the term. Right, now unlike Jack, Joe has to take into account the money which he needs to pay back to the lender. He borrowed £75,000, so that £75,000 comes off of his equity increase. £75,000 is paid off, which leaves Joe's remaining equity in the asset, so the amount of the asset that he actually owns outright, £125,000. Now he started at 25, increased to 125, so his equity growth over the period is £100,000. So if we look at that in terms of return on capital employed, we've now got £100,000 earned, divided by £25,000 initial capital employed, times 100% gives us 400%. So by using leverage in the property market, Joe has actually increased his capital asset value by 4 times that of Jack's stock market bond. Now I'm sure there'll be some of you who are sitting there thinking, now hang on, that's not the whole story here. Joe's had to pay interest for those 10 years, so his real return is actually less than £125,000. And yes, there will be at least one of you who's thinking that, I know, it always happens, but you need to remember an extremely important point. Joe's property is an investment property. Throughout those 10 years, it has been let out and it's been earning its keep. Not only has all the mortgage interest been paid out of rental receipts, But because Joe invested wisely, using expert training and assistance, following the rules set by a professional property investor, he's actually enjoyed significant additional cash flow during that period because the income from the property has exceeded the outgoings on the mortgage interest. So not only has Joe got 4 times the capital appreciation in his investment, but he's also pocketed a healthy amount of cash every month for 10 years. Now, as I say, all these are theoretical examples, but if you keep an eye on our website and social media, we will post links occasionally to actual case studies and also fully worked examples where we take everything into account. So there is more information available if you are interested in looking further into investing in property.